Hello, everyone. Greetings from KL, from Kuala Lumpur. Good day to everyone. And I'm very, very welcome to welcome you to this session. It's wonderful to see colleagues from across our network joining us today. Policymakers, supervisors, researchers, and practitioners, all of whom play an important role in shaping how our financial system responds to the realities of climate change. So before we start, I would like to very briefly introduce myself. Please, next slide, Teresa. Yeah, my name is Laura Ramos. I'm the policy manager, the senior policy manager for the Inclusive Green Finance Working Group at AFI. And just very briefly, I would like to present the housekeeping in the next slide. If you are not familiar with this function, so I would like to request you to mute yourself. And when you are contributed, you can contribute into this session. You can raise your hand. You have this feature at the bottom of your screen. Also, I would like to disable your video and your camera when we are speaking, just to allow to have a better flow in the session. But in case that you would like to contribute, and if it's possible, please switch on your camera and also unmute yourself. If it's not possible, and if you have any question or would you like to contribute with any comment, please also feel free to use the interactive chat box that we have. And we are presenting first, and then we will have our Q&A session. And in the next one, we are, please the next one, and we come back to the photo later. Thank you. So today's session is centered on a question that sits at the heart of the inclusive green finance, and is what happens to MSMEs' access to finance when disasters strike. We know from experience that small and medium enterprises are the backbone of the economies. We know and we are really aware of this fact, because they are the source of job and also providing local resilience. And also they are the anchors of communities' well-being. But also we know that they are among the most vulnerable when climate shocks occur, often the first to be hit and the last to be recovered. So the study that we are presenting today provides new empirical evidence on this challenge by combining industry-level lending data with disaster records. The research shows that when disaster occurs, lending to MSMEs decline and non-performing loans rise, particularly among thrift, rural and cooperative banks. In other words, at the exact moment when SMEs or MSMEs most need financial support to repair, to rebuild, or to adapt, the flow of credit can tighten. And this has implications not only for business continuity, but also for financial stability, recovery trajectories, and resilience at the household and community level. Today is why today's conversation is so important. Supporting resilience is not only about climate policy, it's also very much about financial policy. Our financial systems must be equipped to respond to climate shocks in ways that protect the most affected, prevent widening inequalities, and maintain the flow of capital where it's most needed. During our session, we will examine how disasters shape MSME lending behavior, reflect on the implication of financial inclusion and financial stability, and discuss the role of IGF tools. For example, credits, guarantees, refinancing schemes, risk-sharing facilities, and microinsurance in keeping credit flowing during times of stress. Across the AFI network, we have institutions that are already experimenting, innovative, and taking steps to strengthen resilience. Your insights from the regulatory practice, policy design, supervision, and on-the-ground implementation will enrich this conversation. So with that, thank you all once again for joining us today, and my sincere appreciation to our wonderful speakers for their dedication to putting this important study together. I hope this session will spark new thinking, new collaboration, and new momentum to ensure that not MSMEs is left behind in the green and resilient transition. Now let us begin, but before I introduce our first speaker, can we take a photo? So Erisa can help us taking this group of photo. Thank you very much. And please, Erisa, let us know, okay? Maybe you can stop sharing the screen.
Sure.
Thank you.
Okay, so I'm going to take a photo. 1, 2, 3. So one more. You can turn on your camera, please. One, 2, 3. Okay, thank you so much.
Thank you, Erisa. Okay, with this, I would like to begin with our first speaker. She is Rodora Brasil de Vera, who will set the context by discussing the role and situation of MSMEs in the Philippines and guiding us through VSP ongoing climate-related measures. So Rodora, very well known as Beng, who has played a role in advancing the VSP financial sustainable finance framework, also strengthening interagency coordination on sustainability and integrating ESG considerations into supervisory policies and regulatory reforms, including digital banking and Basel-related measures. So with this, please join me to thank and to invite Rodora to the stage. Thank you, Rodora. Over to you.
Hello, good evening, good morning, and good afternoon. I hope you can hear me clearly.
Yes, very clear.
Okay, thank you, thank you. So it's a pleasure to be with you today. As mentioned by Laura, just to provide some context, on the research conducted by you. So we can move to the next slide, please. So my presentation will cover 3 points. So just some statistics on the MSMEs in the Philippines, and then I'll be touching about some policy support of the BSP to MSMEs, and then the government and the BSP's climate action. So I hope that this will set the stage in understanding the research conducted by you. Next slide, please. Okay, so well, we all know that MSMEs, micro, small, medium enterprises are very important in the economy of every country, similar to the Philippines. Why? Because it also it also comprise majority, or as you can see in the slides, it's 99.6% of the business firms in the Philippines, and we have around 1,241,476 registered business firms in the Philippines. So of this, 99.66% to be exact are MSMEs, underscoring their dominance in the business landscape. And collectively, they also contribute nearly half of the country's gross domestic product, and about 2/3 of the labor labor force or the workforce. And we have around, I think, 9,391,076 391,076 employees. So 2/3 of that are employed by the micro and small medium enterprises. And of course, MSMEs generate around 25% of the total exports of the country. Next slide, please. So in the case of the Philippines, we follow this classification. So as based on asset and employment sizes. So the firm must have total assets of less than 100 million or approximately $1.6 million to be classified as MSMEs. And similarly for employment size, they should employ less than 200 workers. Next slide. So based on the latest data, 2024 statistics, you can see here that the significant 86% of the micro and small medium enterprises are concentrated in just 5 key industries. So almost half are in the wholesale and retail trade, while the remaining almost 40% are in the accommodation, food services, manufacturing, other services, and financial and insurance industries. Well, those in the agriculture, they belong to the remaining 14%. Next slide. And in terms of regional distribution, you can see here that majority are located in economically active regions. So that's 57.4%. So the highest number are still in the National Capital Region and other nearby regions in the capital. So the top five regions account for nearly 60% of all MSMEs nationwide, and the remaining 40% are distributed across the remaining 13 regions. So looking at the distribution by size, micro firms, which represent 90% of registered businesses, dominate across all regions. So on the next slide, okay, so these are the policies and support of the VSP for MSMEs. Although we are not directly we are not regulating the MSMEs, but they do benefit from the enabling regulations that we are issuing. So recognizing their critical role and opportunities arising from inclusive growth, the BSP remains committed to advancing responsive and innovative financing approaches that enable the underserved sectors to access credit and participate meaningfully in the economy. So to this end, we have policy interventions as presented in the 3 pillars. First is on strengthening credit infrastructure. So this pillar focuses on risk management instruments that help reduce the costs and risk associated with MSME lending. And this infrastructure includes a robust credit risk database, credit surety fund, and then we also have the credit information system and guarantee system, as well as the digital ID platform and movable collateral registry. The next strategic pillar, sorry, we can go back. Okay, so the next strategic pillar is the enabling digital and bankable MSMEs and agricultural enterprises. So this is by equipping them with a transaction profile as well as business and financial management skills to facilitate their understanding and to mainstream the adoption of digital payments and other financial products and services that will enhance their operation. So example of initiatives under this pillar is the Paleng QR PH program and also the microfinance program, which facilitates lending for those who lack collateral. And then the third pillar is on the promotion of innovative financing. So this encourages banks to channel resources toward unserved and underserved market segments that are typically excluded by traditional lending models. So examples of this are the agriculture value chain financing. So all these pillars are enforced by, of course, financial literacy programs, which help MSME make informed financial decisions and build long-term resilience. Other policy support includes the mandatory credit allocation for MSMEs. Well, this was enacted in 2008, and there's a sunset period in 2018. So, but from 2008 to 2018, Philippine banks have been mandated to set aside a portion of their lending to MSMEs. But after 2018, there's no mandated credit anymore, but the law that had lapsed is actually being reviewed now in Congress. And then at the height of the pandemic, MSME lending were allowed um, to be an alternative mode of compliance to banks' reserve requirements to further encourage the lending to MSMEs since they are the most affected by the pandemic. And lastly is the introduction of basic deposit accounts. So this one is introduced for banks to offer deposit products that meets the need um, of the vulnerable or unbanked and low income sectors. Okay, next slide, please. So in this slide, you'll see I think around less than 4% of the total loan portfolio of the banking system are extended to MSMEs, and 80% of these are extended by the big banks, the universal and commercial banks, as you can see in the slide, and then and most of that are extended to medium medium sorry medium firms. Okay, so but beyond, however, we note that um, while there's a dedicated line to capture the lending to micro, small, and medium enterprises, we also note that the collection of bank loans to there are some loans that are still not captured because, well, there are some borrowers that apply for personal loans or they use their credit cards. So having used that mode for purposes of reporting, that's not reported as part of the MSME loan. So we see that disconnect. So that's why we're currently revisiting our reporting guidelines to better capture the loans extended to MSMEs, including those the individuals that are operating the micro enterprises. So aside from bank financing, there are also extensions or rather government financial institution and private non-bank financial institutions are also extending MSME financing. And based also on the data that we have gathered, although this is 2023, there's around 21.7 million US dollars in guaranteed loans through the Philippine Guarantee Corporation. So they offer risk sharing mechanisms to lenders, and also 451 point two million US dollars are mobilized from capital markets, signaling growing investor interest in MSME linked instruments. Next slide, please. So, well, this is already related to use research. So this sets the stage. Given the vulnerability of the Philippines to climate change, this actually adds to existing challenges faced by MSMEs. So aside from the usual challenge to accessing the financial instruments or services, the requirement for collateral, so the climate change, the physical risk related risk also add up to this challenges. This was actually mentioned earlier by Laura. Next slide. So in response to the climate risk experienced by the country, you could see in this slide the different efforts extended by the government. So we have the Climate Change Commission and the Department of Environment and Natural Resources, which are the lead agencies in developing the National Adaptation Plan. So this is since adaptation is the priority climate strategy of the Philippines. So we have also developed this, and even the sustainability strategy of the BSP is aligned into this national adaptation plan. And then the Green Force, which is the broader group led by the Department of Finance. They're the one developed the sustainable finance roadmap. So this one provides the high-level action items in promoting the sustainable finance or mainstreaming sustainable finance in the country. And lastly, if we'll narrow down to the financial sector regulators alone, so we have they have developed the Philippine Sustainable Finance Taxonomy Guidelines. And this document also provides a dedicated section for MSMEs in a simplified approach in assessing the activities of MSMEs. And why have this dedicated section? This is to emphasize that MSMEs are not excluded from the sustainable financing. So it's just emphasize that they are important, they are part of the sustainable finance ecosystem. And if I may go to my next slide. So aside from the action of the government, the BSP, as I mentioned earlier, the BSP refined its sustainable central banking program that was launched in 20 in 2020, and also we launched the 11-point agenda in 2022. So we refined this sustainability agenda of the PSP to be more deliberate in highlighting the role of the vulnerable sector that in this sustainability agenda. So we have the mainstream inclusion in the sustainability agenda, and this was actually elaborated in our 2023 sustainability report. And aside from the strategic objective of the PSP, this is actually complemented by the regulations that we have issued. So aside from the regulations enhancing or equipping banks to manage the climate and environmental and social risks, we also issued regulations that encourage the issuance of sustainable bonds like the green, social, sustainability, blue bonds. Actually, there's a bank um, during the pandemic. It was actually the first issuance of social bonds in the Philippines, and the proceeds were used to finance and refinance the needs and loans, extension of loans to micro and to micro, small and medium enterprises. And aside from this, we also have, actually it was also in at the height of the pandemic in 2022, when the AFRD, or the Agriculture, Fisheries and Rural Development Financing Act, was enacted. So this while the law mandates the allocation of 25% of loanable funds to agriculture, fishery sector, and rural development activities. It also recognized the use of sustainable finance instruments such as loans and investments as a form of compliance to AFRD. And then, as I mentioned earlier, for the sustainable finance taxonomy, we have a dedicated section there. And the simplified approach in the taxonomy ensures that the sector is not unduly excluded from participating in the sustainable finance. And the Philippine taxonomy largely draws from the Sustainable MSME Finance Reference Guide, which was developed and published by the IFC. So it also features simplified guide questions following a use of proceeds approach and a non-exhaustive list of eligible projects for sustainable financing for MSMEs. And then we also have some regulatory incentives to extend loans to MSMEs, and currently loans to MSMEs are excluded from the compliance of banks with the large exposures. This is actually a time-bound, or rather a temporary measure, just to help encourage, or rather continue to extend loans to MSMEs, since they are the most they experience the most impact, or the devastating impact of the pandemic. So that's just one of the incentives that we have provided. And then in 2023, we also released the regulatory incentives in the form of additional single borrowers limit, with an additional increase of 15%, and this would expand the capacity of banks to support priority projects of the national government. And then, secondly, we gradually reduce the reserve requirement rate for the issuance of green, social, and sustainability bonds issued by banks. So that's from 3% to 0%. And we're currently reviewing these incentives for potential extension, given also the request of the industry. But nonetheless, the extension is still subject to the approval of the board of the BSP. And then, well, aside from the challenges from extreme weather events to banks operation, we recently released the guidelines amending the regulatory relief policy of the BSP. So we have introduced there some new measures, like the deferment of loan payments, particularly for agricultural loans. So we provided there, I mean, banks may defer the loan payments from 6 to 12 months, depending on the bank's historical experience and assessment of the affected borrowers. And longer deferment periods may also be granted based on the for instance, on the impact of the calamity to the borrower, how much is the damage to the agricultural infrastructure, so something like that. So those are some of the factors to be considered if banks would be extending longer than 6 to 12 months. Okay. And then for the forthcoming policies, these are just some I just presented here some of the forthcoming policies that we are doing right now. And very important here is the prudential report, because it will also allow us to collect not only for data for risk assessment, but also for how much of the financing of banks are extended to MSMEs, and at the same time are classified based on the using the taxonomy. So we're this is an ongoing initiative. So in a way, it will capture both the risk and the financing side. So, and also lastly is the agriculture lending regulations review. This is actually an extension of the regulatory relief policy that we have enhanced. This time it's considering also the experience of our the agriculture sector, the farmers request to if they could be extended. For instance, there's a calamity. Um, they were hit by a typhoon, and their loans should be given a cure period, not based on the standard monthly amortization period, but should consider the crop cycle. So these are just some of the requests relate to us or submitted to the supervision sector, and this is an ongoing study. And we hope, although it will really be a long study, because if we have to consider the crop cycles for all the crops, but this is a work to be done in coordination, of course, with the industry. So I'll end my presentation here, and thank you for listening.
Thank you very much, Rodora, for providing us this context. And also, I would like to take a moment for also appreciating the big effort in providing the data sets to make this study possible. I also would like to thank, of course, Yusun and Professor Ulrich, because they conducted this study. So without more introduction, I would like to invite Yusun. So she is a doctoral research fellow at the Center for Sustainable Finance, SOAS, University of London. Thank you for all this effort, and thank you for being here today. Thank you, and over to you.
Thank you, Lara, for this nice introduction. Let me just share my screen. Can you all see the presentation?
Yes, I can.
Okay, so then let's start. Basically, today I'm going to present the research that we've done on the impact of disasters on bank lending to MSMEs in the Philippines. This is an empirical research paper, and I would like to start with like a sort of quick background and motivation of it. So we all know that climate change increases cross-country and within-country inequality, where emerging economies and developing countries are more affected by disasters than advanced economies are, especially due to geographical disadvantages. And this is also particularly the case for the most vulnerable groups in society, such as poor households and micro, small, and medium enterprises that are also due to geographical disadvantages and the fact of financial exclusion are more prone and vulnerable to be affected by disasters. So AFI acknowledges the fact that financial inclusion of MSMEs is crucial, especially under climate stress. But to date, there has been empirical evidence that was lacking to support sort of like, or to see a data-backed fact of how disasters are affecting bank lending to MSMEs. And so this is what this research project has done. It was conducted to close sort of the gap in understanding sort of financial exclusion of MSMEs due to climate distress in an empirical way. Okay, so with the help of the Central Bank of the Philippines, who provided us with MSME level monthly bank lending data, we were able to then combine this credit registry data set with country level disaster data of the Philippines that was sourced from a data set compiled by my colleague at SOAS, Alex Dryden, using the emergency events database. And so when aligning these two data frames, we were able to then, by the monthly date, we were then able to conduct an econometric analysis, allowing us to see how bank lending to MSMEs is impacted by disasters in the Philippines. Okay, so just to make sure that we're all on the same page, here are some definitions. So the MSME bank lending data from the Central Bank of the Philippines has distinguished lending per industry. So we have 3 banking sectors that we can look into, which are thrift banks, universal commercial banks, and rural and cooperative banks, where thrift banks are financial institutions that are focusing on the accumulation of savings from households and MSMEs, primarily promoting home ownership and financial inclusion, whereas universal and commercial banks are financial institutions that can also act as investment houses. So next to providing loans and other financial services to households and firms, they are also allowed to invest in non-allied enterprises. So these are like these bigger bank houses with investment banking sections within them. And then we have rural and cooperative banks that are privately owned stock corporations providing financial services to rural areas. So they're mostly there to promote and expand rural economies. Basically, the banks who are primarily looking into financial inclusion and smaller and micro firms finance. So I think Rodora has already defined micro, small, and medium enterprises in the Philippines, so I don't have to go into that in more detail. So this is basically the scale of firms that we're looking at, that we can see in this table below. Let's start with sort of like this data description of the bank lending data that I've received from the Central Bank of the Philippines. Here we can see bank lending from 2014 to 2024 in the universal and commercial bank sector, divided into the 3 different firm sizes. So apparently and obviously, medium enterprises receive most of the loans from universal and commercial banks, and we see total bank lending actually increasing up until 2019 and then slightly decreasing ever since, with a slight increase in 2022, 2023 again. Small enterprises and medium enterprises receive lending as well, that have increased over time until around 2019 and then slightly decreased ever since. As for the thrift bank sector, we can see that it is also the case that medium enterprises receive most of the loans. But interestingly here, micro enterprises have, over time, from 2014 until 2021, received more and more finances from the thrift bank sector. So we can see that thrift banks actually have been involved with supporting micro firms' access to capital over time, whereas smaller firms experienced a decline in total bank lending over time in the thrift bank sector. For rural and cooperative banks, all of the three firms have experienced increased bank lending. Most of the lending from rural and cooperative banks have been given to smaller firms, which makes sense because in rural areas, we assume that there are more smaller firms that are settled there and micro firms, which is the blue line here, that have also experienced a higher bank lending opportunity. Okay, and so this is what we look when we look at total bank lending. We can also look at the non-performing loan rates per industry and firm size, where for micro firms in a universal and commercial bank sector, this is the orange line here, we see a decline in non-performing loan rates. That's quite significant, from around 6% in 2014 to around 0.5% in 2024. So that shows us that micro firms have actually performed much better over time in the UKB sector, at least. For thrift banks, this NPL rate has remained constant. And for rural and cooperative banks, we can see like a slight U-formed development. If we look at smaller firms, the evolution looks a bit different, where thrift banks actually experienced a higher NPL rate over time for smaller firms. So smaller firms that have lended from thrift banks have more and more experienced a rate of default, which is an interesting development. And then for the universal commercial bank sector, the NPL rate remained mostly constant, similarly for the rural and cooperative bank sector, with here and there smaller bumps. If we look at medium firms' NPL rates, again, in the thrift bank sector, there's abnormal, I guess, evolution, where we see a decline in NPL rates over time, and then an increase in NPL rates ever since 2018. For the universal and commercial bank sector, non-performing loan rates remained constant. And for the rural and cooperative bank sector, we see little bumps in there too, but it is the trend is declining. So what we can see from the data that's now shown in these figures is that there are specific dynamics in the data that goes up and down. And so what I in this research project was then thinking about is more the reason why we see these different dynamics in the evolution of total bank lending and NPL rates, and how disasters might have played a role in sort of affecting these ups and downs. And so in this research project, two hypotheses have been built here, where the first one would be that to think about these different dynamics in the total bank lending over time to be due to natural disasters. So if disasters happen, then naturally total bank lending should decrease. So that's the first hypothesis. And the second hypothesis is logically the same, right? So if disasters occur, then we would probably assume that NPL rates of MSME loans will increase. So these are the two hypotheses that I wanted to test with the econometric model that has been that is displayed here. We see on the left-hand side is the dependent variable of total bank lending 1, 2, and 3 months after disaster occurrence, and also NPL rates 1, 2, and 3 months after disaster occurrence. And on the right-hand side, we see the independent variable, the explanatory variables of the disaster, which is a numerical variable indicating the severity of disaster occurrence, where 0 equals no disaster occurrence, 1 equals small disaster, with a population affected being smaller than 2%, and damage as percentage of GDP smaller than 1%. And if it is equal to 2, we will see this would represent a major disaster, where the population affected will be larger than 2%, and the damage as percentage of GDP is larger than 1%. Furthermore, we have like two control variables, total affected, namely the total number of people affected by the disaster, and total damage, as in the monetary value of disaster-related damage in Filipino pesos, adjusted for inflation. So this is our econometric model. And if we run regressions on these equations, we will have around 6 regressions per industry. So for thrift banks, we have 6 regressions according to total bank lending 1, 2, and 3 months after disaster occurrence, and NPL rate 1 to 3 months after disaster occurrence. Okay, so let's look at the results. Okay, so here are the regression results for thrift banks. First and foremost, you can see that for the dependent variable total bank lending, yeah, if the number of total affected increases by 1 unit, we can actually see an increase of a decrease in total bank lending by 0.00291 units at a 5% statistically significant level 3 months after disaster occurrence. We also have statistical significance for the lead of 2 and 1, so 1 month after disaster occurrence and 2 months after disaster occurrence at a 10% statistically significant level. But I think the 5% statistically significant level just makes the result more robust, where we can see that actually it is the case that in the thrift bank sectors, once total number of affected people by disaster increases, total bank lending actually really decreases. And that's a trend in the data, right? So this allows us to say that the hypothesis that we've built, like the number 1 hypothesis where we say total bank lending must decrease after disaster occurrences, actually really does hold for the thrift bank sector. And then if we continue and look at the NPL rates as a dependent variable, we can also see statistically significant results for the lead of 2 and 3, where an increase in the number of total affected by 1 unit will actually lead to an increase in non-performing loans rates 2 months after disaster occurrences at this percentage level. This is also a very significant result that actually allows us to say that hypothesis 2 does actually also hold for thrift banks. Namely, if disasters happen, which is when total number of affected people increase, then we can actually see an increase in non-performing loan rates. So more firms, micro, small, and medium firms, will default. So incredible results here. And now for the thrift bank sector, right? And now we've done the same thing for the universal and commercial bank sector. Here, unfortunately, we didn't find statistically significant results. And the reason for this must or could be that UKBs, universal commercial banks, have primarily lent their capital to medium firms. Like a large chunk of the capital given to MSMEs are actually given to medium firms, whereas for thrift banks and rural and cooperative banks, this divide is equal. So it's almost the same amount that's been given to universal, to micro, small, and medium enterprises for thrift banks and rural and cooperative banks, whereas for the universal and commercial bank sector, this is a bit disproportionately divided, and most of the loans go into the medium firms. And there we can assume that medium firms might be more financially stable if they employ 100 to up to 200 people. Then maybe disasters have less of a financial effect on them, and they're more able to secure business operations and build resilience and stuff. And this is why maybe we don't find statistically significant results for the UKB sector. If we look at the rural and cooperative bank sector, though, we find similar results as for the thrift bank sector. All right, here we can see for the independent variable D disaster, which is the numerical variable, right, where 0 is no disaster, 1 is small disaster, and 2 is major disaster. We can see that if D disaster increases by 1 unit, then total bank lending for the lead of 3 decreases by 20,347 units. this similar results for 2 leads and 1 lead at a 10% statistically significant level. So we do see that if the disaster happens, and the larger the disaster is, the more total bank lending will decrease to MSMEs coming from rural and cooperative banks. Okay, so it's similar result as for the thrift banks, where disasters will lead to decreasing bank lending behavior from rural and cooperative banks. As in the NPL rates, this is again a positive relationship where an increase in the disaster, so a disaster happens or the small disaster becomes a major disaster. This will also show that NPL rates will increase by 0.00459% at a 5% statistically significant level 2 months after disaster occurrence. So here we can also say that hypothesis 1 and 2 hold, where disasters lead to decreasing bank lending of for MSMEs in the rural and cooperative bank sector, and to an increase in non-performing loans rates in the rural and cooperative bank sector. So to conclude here, these were the main results of this econometric analysis. We can really say that for thrift banks and rural and cooperative banks in the Philippines, total bank lending will decrease or decreases after disaster occurrences, and non-performing loan rates increase after disaster occurrences. This shows that actually MSMEs will get less finance when disaster happen, which is actually very counterproductive, because during disaster occurrences, MSMEs who are already vulnerable actually need more finances than less to secure their business operations or their livelihoods and to build resilience against climate change. But instead, financial exclusion is exacerbated by disasters. And this will lead to a vicious cycle of MSME financial exclusion during climate change that can have a significant impact on economic stability, as we have heard from Rodora and also Laura, that MSMEs are the backbones of economies and contribute significantly to GDP growth and employment. So during disaster occurrences, we have data-backed proof now that bank lending will reduce, leading to more non-performing loans and financial exclusion. That is exactly the opposite of what MSMEs need in that case, in that scenario, right? So there's an urgent need to design just transition policies that join green finance policies with financial inclusion policies, building on the inclusive green finance framework to secure green finance being channeled to vulnerable sectors, to vulnerable populations, groups in an economy, which is MSMEs in this case. And how can we do that? So there are 3 sets of policy recommendations that this research project has come up with, which is first of all that we need to raise awareness of this fact, of this data-backed fact that MSMEs will experience a heightened vulnerability to post-disaster financial exclusion. So policymakers and financial institutions, they must raise awareness and acknowledge this fact that is now data proven through this research project. So after this awareness has been raised, then governments, central banks, national development banks, and multilateral development banks can build institutional capacity to design and implement IGF policies that address this MSME vulnerability. So once this institutional capacity is built amongst these institutions, then we can actually channel green finance towards these vulnerable MSMEs through targeted and market-shaping IGF instruments. And there are quite a lot of possible IGF instruments that can be implemented, such as green credit guarantee schemes, targeted refinancing options, direct lending policies, digital finance tools such as mobile money, microinsurance, and many other possible ways to do that. But first of all, we need to make sure that awareness is being raised. The research results that have come up here, that this is being spread amongst policymakers and financial institutions, and then institutional capacities is being built, and then we can actually implement targeted and market-shaping IGF instruments to assure a just transition and to assure financial inclusion of MSMEs during climate distress. Okay, I guess this is it from my side. These are the references I used during this presentation, and thank you very much for your attention.
Thank you, you. This is very, very exciting and very, very interesting. So before I move to the questions, because I have one here, at least I have one, as everybody's asking for the paper and the slides. But before we continue with this Q&A, or we start the Q&A session, I just would like to kindly request to Professor Ulrich if he would like to contribute to anything, or if he would like to ask anything that we are discussing here.
Thank you. No, I was actually just typing a comment that saying I fear I need to log off now. But I think in any case, I think the presentation was very clear. So I think it gave a good overview of what the challenges are, and also a reflection on what the solutions may be. And I think the research very much reinforces that fostering inclusive green finance, having a strategic approach to inclusive green finance is really crucial, because this research has been backward looking, so using historical data. And if there's one thing that we definitely know about climate change, is that if anything, things are going to get more difficult going forward. So the number and intensity of climate shocks are going to rise, and if countries don't invest in adaptation resilience, and if importantly small and medium enterprises and also poorer households can't invest in more resilience, and they will be ever worse affected. And this research shows that we already see a retrenchment of traditional financial institutions from firms that are at risk of climate shocks and so on. And so I think the IGF agenda is very much reinforced through this research, and so important to keep up this work and intensify it. Thank you.
Thank you, Professor. Okay. With this, I think that we are proceeding with the questions. I see one here from Stephen. Stephen, would you like to unmute yourself and raise a question, or do you want me to read it?
Yeah, Laura, thanks so much.
Thank you.
Please, can you hear me?
Yes, very clear.
Yeah, I think just to say that that's a very brilliant study. I think the professor has said it. I think I don't need to add, but I wanted to appreciate from the study, because I saw one of the graphs, the NPL reduced from 6% to 0 point something, for over the years. And I wanted to appreciate whether was it as a result of the maybe policy from the central bank for that industry to reduce the NPL, therefore they came out with a policy like write-off policy or anything of that sort. If that is why we see the NPL reduce from 6% to that 0 point something percent over the years, could it be that? So then I wanted to appreciate if the study considered that, though that it will not be like, and of course the interpretation will be that if there is disaster, we all know, of course, it's going to affect NPL. But then now we do see NPL, which has reduced within the period the study considered. And it wasn't as a result of disaster, of course, or maybe something. But is it a case that the central bank issue a policy for NPL to be reduced? And how did the study consider that in the interpretation of course, or in respect of the outcome of the study. I just wanted to appreciate that. But I think, like you said, it is obvious that when there is disaster, clearly it's going to affect MPL. But I want to appreciate that also from his perspective. What was the effect of policy from the central bank on these MPLs? Thank you.
Okay, so I guess your question, if I understood it correctly, is how sort of central bank policies that try to reduce MPLs within the period of disaster occurrences have been considered in this study, right?
Okay, I think we can take it from there. Thanks so much. Yeah, yes, please.
Okay.
Line is back.
Yeah, so what has been done here is this econometric analyses that looked at total bank lending and NPL rates over time, like the increase and decrease in that sort of decade from 2014 to 2024. And the dynamics that are shown in the NPL rates, yes, maybe some of it could be due to other external factors such as policy implementations or such as GDP growth and other variables that might be. But in our analyses, we focused on how disasters have affected these dynamics over time. Okay, so the econometric analyses, and that was the econometric model that we used, has used independent explanatory variables that are linked to disasters and not linked to policies or other variables that can be looked at specifically because we wanted to sort of isolate the effect of disasters on bank lending and NPL rates. But it is a fair point. It might be that policies from central banks have also induced specific dynamics, but this is not the focus point of our study here.
Thank you. Thank you very much. Thank you for that clarity. Thanks so much.
Hello. If I may just address partly your question, Stephen. First, there's no policy change on NPL involving the period covered in this study. But I recall that during the period considered in this study, there are a lot of bank closures. So I think that may also contribute to the reducing of the NPL level.
Thank you very much. Yeah, thank you.
Thank you.
Thank you. Thank you, Stephen. So yeah, I would like to proceed with one question for, well, first you that we are discussing these points, but it's more like, what did you find most surprising or counterintuitive in the results, especially regarding lending behavior during disaster periods? If there was anything that you found like very surprising or something that's, yeah, was not really intuitive.
Yeah, I guess, I mean, it was quite clear, theoretically speaking, that disasters will probably have a negative effect on total bank lending to MSMEs, and NPL rates will probably increase. But I think for the rural and cooperative bank sector, we have seen slight contradictory results for either if we look at the disaster as the independent variable, or if we look at total affected and run sort of the regression on NPL rates. then there was this one results where we saw NPL rates actually decreasing for one of the months, which was quite contradictory to me. So I think that was something that was surprising to me to see, okay, actually we assume NPL rates to always increase after disaster occurrences because firms will default, the loans will default because they will not be able to provide enough financial stability for themselves. But on one of the occasions, actually we saw NPL rates decreasing. And that is a result that I think can be also differently interpreted, which I think was a bit counterintuitive, but nevertheless an interesting result. Yeah.
Thank you. Thank you very much. So before we wrap up, I also would like to come back to Rodora for one question. So then, what role do partnerships and interagency coordination play in building a more resilient financial system in the Philippines?
Okay. Well, Laura, before I answer that question, I may just add something to what you said earlier about the something contradicting. Yeah, I think the changes in policy may partly explain that reason because we institutionalize the regulatory relief policy in I think in 2018 or 20 or the latter part of 2017. But prior to that, whenever super typhoon or any calamities would hit the banking system, the BSP will release a list of relief measures, and at that I think at that time, banks are allowed not to account the affected loans as part of the NPL or past due. But with the change in policy in 2017 or 2018, we um, we require the banks to have parallel reporting to BSP. One that still account for the affected loan as part of the past due or NPL, while the other supplementary report is they exclude the NPL. So in the figures that we are monitoring right now and also published at the BSP website, those reflect the NPL, the true NPL ratios, meaning if the loan is affected by typhoon, that is classified as NPL. But for purposes of supervisory, I mean for instance, in extending some supervisory relaxation or assistance to the bank, we use the supplementary report wherein part of the loan is adjusted or deducted from the NPL, but that is for supervisory purposes only. And I hope that's clear. Okay, and to answer your question, Laura, well, partnership and interagency collaboration is very important for building the climate resilient financial system, no? As this will allow us to align our policies and also learn what are the available data from the other agencies that would also inform our risk assessments. And as I mentioned earlier, MSMEs are not regulated by the BSP. So we need to coordinate with other government agencies, for instance, the Department of Trade and Industry, to also know their programs, the statistics, and then we can align our own policy initiatives to support the program. I think one of the projects of the BSP is the credit risk database. That's one also of the initiatives identified in the MSME development plan of the Philippines. So that's a contribution of the BSP to that development plan. And also, as I mentioned earlier, we have the National Adaptation Plan, and our sustainability strategy is also made aligned or consistent with the national strategy. So, so this collaboration is very important to make enabling more effective regulations. Thank you.
Thank you. Thank you very much. I don't see more questions. And also, I think that we are reaching our time. So just to wrap up this session, I just would like to mention, I think that what is more relevant discussed here, and we have been discussing this for almost a whole year, about how can we address MSMEs, or how can we build MSMEs resilience against their climate vulnerabilities. I think that, as you mentioned, interagency coordination is quite relevant. It's very, very important, not only for channeling finance, and also for, as you say, strategize this sector through policies, through strategies, through NFIS. I think that also the role of policymakers is to build, or to raise awareness about all these vulnerabilities, and the importance that this, or the impacts that it has into the sector. And not only because it hits the sector itself, it's just because also affects in a big proportion the national economy, affecting jobs, affecting the value chain. So I think it's quite relevant. And of course, I think another quite important topic is, or key takeaway is, the institutional capacity that must be implemented in order to not only progress on the IGF policies to address such vulnerabilities, but also to create these capacities for implementing, supervising, and also monitoring all these policies. And with this, I just would like to thank you again. Thank you for this incredible study. I think this is the first ever that we are having here at AFPI, and yeah, we are very pleased to be working with of course, with the Banco Central de Filipinas, and also with SOAS University. So thank you very much, Bang. Thank you very much, you. And thank you all. I just concluding saying thank you very much, and have a great night or day ahead. Thank you again.
Yeah,
Thank
my
you.
pleasure. It was a very interesting exercise. All
Thank you.
right.
Thank you. Thank you.
Yeah.
Thank you.
All right. Bye.
Bye.